Hello traders, Gary Wagner here, 12:55 in Honolulu, 6:55 in New York on Friday. Happy Aloha Friday, as we say on the islands. First day of September 2023, and this is the Weekend Review. Gold finished higher on the week. However, as you can see in this daily chart, although gold closed in essence unchanged, what is interesting to me is the exaggerated high that occurred intraday coming down after the release of the government's jobs report today. It traded to a high of approximately $1,980, which is also where the 200-day simple moving average occurs. We will remain long into this extended three-day holiday weekend as Labor Day occurs and celebrated on Monday. But it is the weekly charts that I want to focus on today's weekend review because we found a significant pattern, but more importantly, this week we can identify the confirmation of the pattern I'm talking about, a piercing line. Although a piercing line is a two-candle bullish reversal indicator, and in fact, when identified on a weekly chart, has more significance in terms of the potential move in gold or the price gains. To properly identify this pattern, it has some pretty simplistic rules. Rule number one being that the pattern must occur after a defined price correction. We can see that on May of this year, gold traded to its highest value of the year, well above 2,000, and corrected strongly all the way through the middle of August. On August 14th, we see this large red candle that forms the first candle of this two candlestick pattern. In the case of a weekly chart, the first week. Following the long red candle that occurs on the 14th of August, that will be followed by a large green candle that will open at or below the closing price of the prior candle and close at or above the midpoint of this red candle. That is exactly what we saw occur, which takes us to current pricing and the current week, this weekly candlestick here. Because it's only a two-candle pattern, it requires a confirming candle. In the case of a bullish reversal pattern, that confirming candle would be a green candle with a higher high and a higher low and higher close than the previous candle, which is precisely what occurred this week. A very strong showing on the weekly with fractional gains on the daily. That is why I believe that in terms of our upside target, we need to look at these two real bodies that occur in July as well as these highs. The real bodies come in just around $2,000 per ounce, which is why I believe that that is our first key target or level that we would hope to achieve in terms of our exit strategy on our current long position. It could trade into these tops, which come in at 2027 here and 2022 here. But traders, if we reach 2,000 and challenge that price point, I will be extremely satisfied as we'll be able to pull a nice profit. If you recall from yesterday's show, I talked about the fact that as far as silver is concerned, we purposely withheld issuing a buy signal on our trade alert because I believed that silver had more downside potential. That is exactly what we saw today. Silver lost 27 cents or 1.11%, taking the most active December contract to $24.54.5. In terms of strategic areas we could find support, this low today does not occur at any significant top or bottom when we look back historically short term, and the real level of strong support is where the 250-day simple moving averages converge and cross. That would be where I believe you will find support. We are currently at 24.60. Look to buy at approximately 24.20. This is Gary Wagner wishing you, as always, good trading. We will return after the three-day holiday weekend on Tuesday. Have a great weekend. Bye-bye.